What is up, guys? It's the boy, the LifeofSol, aka the bodybuilding banker, and I am back. And in today's video, I'm going to be talking about my experience as an investment banking analyst working on a multi-billion-dollar transaction. Stay tuned. So in case you're new to my channel, my name is Sol. I'm a fitness enthusiast, investment banker, and I post content surrounding fitness and finance and generally vlogging my lifestyle, showing that you can have a healthy work-life balance. Now, with that said, let's get into the video. So I thought it'd be helpful to start and understand what M&A actually stands for. M&A stands for mergers and acquisitions, and this is usually where an investment bank is hired to either buy, sell, divest, or acquire smaller divisions of another company. So there's normally two sides of transactions. You've got sell side M&A or you've got buy side M&A. Sell side is when you're hired by the company to help sell a business, and buy side is, as it says, you're acquired by a company to help buy or acquire a business. So one caveat is that as an analyst or associate or even VP at times, you don't necessarily advise on the deal. Your main role is involved with helping execute specific tasks which are really important to the overall deal process. So a lot of time is spent in Excel doing financial modeling. This is normally used to determine the value of the business, how much you're going to pay for it, how much is it worth now, what assets do they have, and what price can you determine today that is the sum of the overall value of the business. And we can go more into the different valuation methods. Or you're creating fancy PowerPoint presentations which will be presented to management, C-suite professionals, the CEOs to help present the business in a very seller or buyer friendly format. Now, it's extremely important to make sure these tasks are executed at a very high level. And remember, in my experience, it was a very stressful time. Generally, these clients are paying millions of pounds or dollars. You as an investment bank are allocated a success fee. That's normally a percentage of the overall deal. And so it's really important that you deliver to a high standard, because your presentation will be shown to a board of directors. These will be very important people in the deal, and your numbers have to be watertight. This is going to determine the value of the business, so it's important to get everything right. So I liken working on an M&A deal to being part of the Avengers. You as an investment bank play an important role when advising a company on an M&A deal. And the way I can describe it is almost being like an estate agent helping someone to buy a house. However, if any of you have bought a home, it's really important to understand there are different parties involved. And generally, when you're doing something such as high profile as an M&A deal, you have lawyers who make sure everything from a legal perspective is watertight. You've got accountants to make sure you consolidate the financial books. Imagine when you're buying a business, you want to make sure that the revenue number is what they're saying. You want to make sure there's no hidden costs, there's no hidden lawsuits. And so accountants are really good at going through the numbers to make sure everything looks as what it seems, because generally companies, if you think of it, want to present themselves in the best light as possible, especially if they're public companies and they have shares. Putting good results will make their share price go up. So you have to make sure that nothing is missing. And finally, you've got consultants. One of the rationale to buying a business is that you believe that you can produce a new product offering, and maybe you believe you can capture 10% of the European market. While consultants are fantastic in doing due diligence, understanding the market, understanding key barriers, whether there's any economies of scale, whether the competitive landscape is maybe a monopoly, so there's one key leader which is really hard to break, or there's an oligopoly where there's a number of key players who have a large percentage of the market, or it's fragmented and there's a great avenue for your company to come in. So all in all, it's really important to have a strong team. And as an analyst, you have to make sure you're collaborative so you can work with different parties when executing on an M&A deal. Now I'm going to go into some of my roles and responsibilities as an analyst and what it was like when I was working on an M&A deal. So I remember it being a pretty chilled week. I'd managed to go to the gym. I was still working quite long hours, or relatively long. I was still working 12 hours, so 9 to 9, maybe 9 to 10. But that's generally seen as all right in M&A. Sometimes you get out a bit earlier. And then I remember having an email and being called into a room. So the way deals are generally structured is depending on how big the deal is and depending on your bank, you have at least one one person per level. So what does that mean? It means you'll have an analyst on the team, you'll have an associate of the team, and depending on how your bank is structured, you'll have a vice president of the team, and then you have the partners. And the partners are the ones who broker the relationship. They've been through multiple deals, they've been in the industry for multiple years. And as you trickle down, a lot of the grunt work, should I say, is done by both the analyst and the associate. So I was working on a pitch for the company and another deal which was a lot slower pace. A pitch is where maybe you've been doing corporate strategy work for a business with the intention of working with them on a deal, and you get some indication by the board that they're looking to sell and they're looking to hire an investment bank. And so you pitch yourself as a bank, right? You pitch why you're the best investment bank to help them execute the deal. So generally on the pitch, you do a PowerPoint presentation and some form of valuation to determine what value their business would be and how you would allow them to extract and achieve the best value. So on that pitch, I was working on presentation material. So talking about the deals we'd worked on as an investment bank, talking about the market and why we believe they can achieve a certain value. And of course, I was doing a lot of Excel and doing valuation analysis. I can go into valuation analysis in a separate video, but generally you're determining what price you can pay based on maybe their historical. So that's more like a DCF. That's more of an intrinsic valuation. So determining based on the cash flows they have now and future cash flows, what price today you would pay for it, and you will take into account, their cost of debt, their cost of equity, or you do more of a market-based valuation. So that's using comparable company analysis, and as it states, it's just comparing the current company based on their operational and financial characteristics to other companies out there that are very similar to them. So let's say it's a public company, which is a lot easier because the information is publicly available. You can go on information and data centers such as Capital IQ, Bloomberg, Reuters, and pull information that tells you how they're trading. And there's multiple ratios you can use, such as the P ratio, the price to earnings ratio, or EV to EBITDA, so the enterprise value, and EBITDA is just a proxy for cash flow. And based on where their peers, so companies similar to them, are trading, you can determine what value you'll pay for the business. And generally you present this in a deck, potentially in a football field. Now the football field can be confusing. It's like an American style field, and I'll put it here. But a football field generally shows you, where the valuation stands and what different buyers will pay for it. So the two main buyers you have are strategics, which are other companies that operate similar to them, and then you've got private equity companies, or they call them sponsors, and they generally form a price floor. And what I mean by that is private equity companies try to buy companies, hold them, and sell them for more. And so what they're looking for, in very simple terms, is getting a good deal, and they want to come and improve the company and sell them for a greater return, or IRR. Strategics generally, especially if you base it on transaction comps, are willing to pay a control premium for assumed synergies. So a control premium is saying, hey, this business is maybe valued at, I don't know, I'm just throwing numbers, 100 million. We're willing to pay 120% of that price. So let's say 120 million in order to acquire the business and control the business with the assumed synergies. So yeah, that's generally what you do on a pitch. Now I'm going to talk about what I did on the deal. Both the analysts and associates, as well as understand the key principles of the deal. So they play an important role. But as an analyst or an associate, especially depending on how your associate is, if they're hands-on or if they're, they just leave you to it, everything comes to a stop, because when it's deal time, it's crunch time. So going back, I remember it being midweek, and yeah, I just got called into a room, and it was like, we've been mandated. And once you hear that word, it's about to be hard work. We've been mandated by a certain client. They're looking to sell their business. We're going to go through a sell side process, and we generally break down what it is. So on a sell side process, we have to do a lot of different tasks, and what we try to do is allocate the tasks, create a time frame, and really be, steer that ship, really be on point when it comes to executing the deal. So once I was given the brief, as an analyst, it's important that you understand the business. So I took some time out. I tried to read as much as I can on the information available, generally the management of the business, send some key and sensitive information. So this could be information about their suppliers, their products, the markets they are in, the markets they plan to be. The essence of that is to give you a holistic picture to best understand the business. So again, you can present them in the best light. And so as an analyst, what I try to do is digest all of that. So going through the annual reports, reading the relevant news articles, going through previous presentations, and making sure that I'm up to speed. This took me till about 11 p.m. in the day to make sure I was pretty confident, and also to make sure that I could ask any questions to an associate, because as an investment banker, it's really important that you know what you're doing, but you also vocalize your approach in case you're going, the wrong direction. And I learned that lesson very early on. It's best to, communicate. I plan to create the deck this way. And a really smart thing is that what it does, it brings a responsibility to the other person, so say it's your associate or vice president, because you vocalize your approach, you've told them your plan of action to execute, and so you've told them and they've agreed with your approach. Now you're fine as long as you deliver what they said. They're the ones held accountable. So that's a really good tip I'll tell you when going forward. So I'd worked on a few deals before. I'd worked on a really big transaction in my previous firm, but I hadn't really worked on a deal from start to finish. So I took a bit of time the next day to really understand previous deals. Nothing is made from scratch in investment banking. Generally, unless it's a really specific situation, most things have happened. So I try to leverage of existing materials to make sure I have a good understanding. And then the next day we were called in a meeting room to make sure everyone understood what was happening. And then we divided the tasks. So I was in charge of creating the teaser and the IM. The teaser is almost similar to what it says. It's a teaser document. And what that means, it's a document which presents the key investment highlights of the business. So where they operate, their market positioning, their different products, their brand, key financial numbers, so their sales, maybe their EBITDA margin, to show how well the business is doing. And what this is used is, it's used in an auction process. What do I mean by this? When you're working on a sell side deal, you're helping the business sell to your network of potential buyers. And so you need to select a buyer universe. So in selecting a buyer universe, I have to determine, also using my seniors' help, the different buyers that have bought these companies before and would be interested. And so the teaser is really important, because this helps shape the interest in the initial first round to determine the level of engagement when coming to present this business. Because what you don't want is that you create a teaser, you do all this hard work, and none of the buyers are interested, or maybe they've done a similar transaction in the space and don't have the cash or capital. So it's good to understand the financial capability and the track record of the different businesses when selecting the buyer universe. But again, this is something that you consult with the senior management and also the client itself, because they might have some inside intel to better understand the different buyers. Now, it's really important to make sure you deliver what the client asks, but to go above and beyond. That's generally what investment banks do, and that's why we work so hard. I remember the next day we had a call with the client to make sure that they understood everything. So we asked key questions about, their numbers, because again, they're trying to present their business in the best light, and we have to make sure we are accurate as possible, because what generally they do is they get a consensus view. And what I mean by that is, whilst we as an investment bank are working on this deal and determine the valuation, they generally get other investment banks to have a consensus view. So if you have, say, a business and you value them at 500 million, but other banks value them at 800 million, your client's going to come and say, what's wrong? Like, why am I missing 300 million? So you have to make sure you ask certain questions to make sure you fully understand the business so that your valuation is on point. So going back to the deal, I remember working on the teaser and also that the financial model the client had sent. I had worked that night to, let's say, 2 a.m. Again, I hadn't had much experience in building this sort of model. And so it's really important for me to just do my best, but also look at other examples. And that's what it's like working on a deal. I had to go through the different drivers of the business. I had to understand, what are the key operation factors of the business. I have to make sure that I'm looking at the right historical numbers, because history doesn't necessarily determine what the future would be. So it's when you're building a financial model, you need to understand the operating metrics. What do I mean by this? What drives their revenue? Revenue is split into price and volume. What's determining their price? Is it going to change? How much are they producing if they're a consumer-based business? And then, if you want to look at gross profit, you need to understand their costs. What are costs broken into? Fixed costs. So do they have any hard assets? Are these assets going to depreciate? Or variable costs? This could be like materials, employees. So a lot of margins you look at your cost of good margin, you look at your gross profit margin. And one of the most important things that business value is EBITDA. And you want high EBITDA. If it's a high EBITDA margin business, that's really good because you can extract more value when trying to sell the business. So now we move on to a Friday. And Friday is generally an investment bank. You try to leave early. Most Fridays, if I'm not too busy, I get out of the office 7, maybe even earlier. And with the, post-pandemic, actually, you're working from home a lot on Fridays. So it tends to be more relaxed unless, of course, you're working on a deal. So on the Friday, I had a Zoom call, or Teams call, should I say, with my associate to run through what I had done. And they gave their feedback, and I had to make the relevant changes, show them my model, which was a pretty good model for a first attempt. And again, they gave their feedback. Now, a lot of people would think, why doesn't the associate do it? Well, if you think of your trajectory in investment banking, the aim is that you're able to go from analyst to associate to vice president, if you stay on, to managing director to partner. So you need to be able to execute the responsibilities of the different people within your team. And a really good analyst always thinks ahead and takes less pressure off the associate, for example. So, and the final thing is your associate is busy. Like, that's not the only deal they're working on. They're working on a multitude of transactions. So you have to make sure that you can take the pressure off so that they give you more responsibility. And so they're able to execute different parts of the deal or any other deals that they're working on.